Did you know that 98% of Australians can't explain what superannuation tax components are? Now that's a 100% made up statistic, but I reckon it's pretty close to the mark. Because really, who cares about superannuation tax components? Well, you should. Simply watching this 6-minute video could save you and your family tens of thousands of dollars in tax. But more importantly, it'll make you part of the 2% club of people who know what super tax components are. And if you've achieved nothing else in life, then that's something you can be proud of. G'day, I'm Chris Strano, the founder of Super Guy, the place where Australians go to maximise their super and build their own retirement plan. Make sure you never miss a video by clicking the subscribe button and turning on notifications. Alright, let's get started. Tax components are actually quite simple to understand and pretty relevant too, but not many people actually know about them and how they apply. Anyway, give me 5 minutes and you're going to be an expert. Alright, so every super balance is made up of two types of tax components. There's tax-free components and there's taxable components. Taxable components are further broken down into taxable taxed components and taxable untaxed components. But we're just going to stick with tax-free and taxable for now. So let's begin on how tax components come about. So when contributions are made into your super account, they either count towards the tax-free component or the taxable component, depending on the type of contribution. So all concessional contributions, such as employer SG contributions, salary sacrifice contributions, and personal concessional contributions will count towards the taxable component. And all the non-concessional contributions, which are personal after-tax contributions, will count towards the tax-free components. Therefore, for people who haven't made any large personal non-concessional contributions into super, the majority of their balance will probably be made up of employer contributions or deductible contributions such as salary sacrifice or self-employed contributions, and the majority of their balance will consist of the taxable component. And it's not only concessional contributions that count towards the taxable component, all earnings within a superannuation accumulation account will also be allocated to the taxable component. So the actual way of calculating the tax components of your super balance is the tax-free component equals the total non-concessional contributions. That's the tax-free component. Taxable component equals the total super balance minus the total tax-free component. Okay, so the tax-free component, being the total non-concessional contributions, is the total non-concessional contributions ever since your super account was established. So not just this year, all the non-concessional contributions that have been made to your account count towards the tax-free component. And using these formulas is how you figure out the tax components of a superannuation accumulation balance. However, once you use your super to start an income stream, such as an account-based pension or a transition to retirement pension, your tax components get crystallised and locked in as of the day the income stream commences. So if, for example, let's say you had a super balance of $500,000, which was $400,000 taxable component and $100,000 tax-free component. Once you start a pension, it would get locked in as a 20% tax-free and 80% taxable pension. And also, unlike an accumulation account, all of the earnings from investments would be allocated proportionately between both components, so that it would forever remain a 20% tax-free, 80% taxable split. Does that make sense? All withdrawals also need to be made proportionately from each component, so each pension payment from your income stream would be 20% tax-free component and 80% taxable component. By the way, the same rings true if you were to make a lump sum withdrawal from your accumulation account. The withdrawal needs to be made proportionately from each component. The only difference with an accumulation account is that earnings are not proportionate between each component. In an accumulation account, all earnings go towards the taxable component. Now you're probably thinking, hang on, does that mean that some of my withdrawal is taxable and some isn't, even if I'm over age 60? Not exactly. This is where terminology can get a bit confusing. It did actually used to be that way, but in 2007, all withdrawals for people over age 60 became tax-free. So tax components became irrelevant to a degree, but not entirely for people over age 60. Basically, even though your super withdrawals or pension payments may consist of both taxable and tax-free components, you do not pay tax on any of these withdrawals if you are over age 60. The withdrawals are completely tax-free. However, if you are under age 60, only the tax-free portion of the withdrawal is guaranteed to be received completely tax-free. The taxable portion is assessed for tax. There are some exceptions on the taxable portion being assessed for tax on lump sum withdrawals, but basically the taxable portion of a lump sum withdrawal is assessed for tax, and the taxable portion of a pension payment is assessed for tax. The only time tax will be payable on withdrawals for people over age 60 is if some of your balance consisted of the taxable untaxed component, which honestly, it's not very common, but it is possible. And a taxable untaxed component might be in your super if you were part of an untaxed defined benefit fund or maybe receive some type of insurance proceeds into your super account. But for the very large majority of people, you do not need to worry about tax on withdrawals or pension payments over age 60. Tax components also come into play if you pass away. So if you die and your super death benefit payment is paid to a non-tax dependent, such as a child over 18, the taxable portion of your super will be assessed for tax when they receive it. The tax-free component will be received tax-free though. Now, the specific tax payable on lump sum withdrawals is another video on its own, as is the tax on pension payments and payments resulting from death. This video would go on forever if I tried to cover all this. The purpose of this video was to purely explain how tax components come about and how they apply, which I hope they did. I would now like to officially welcome you to the elite group of Australians who understand superannuation tax components. If you enjoyed this video, please take a quick moment to hit the thumbs up button to show your support. Don't miss out on my exclusive superannuation tips, and sign up for my newsletter at superguy.com.au and get them straight into your inbox. Thanks for watching, and I'll see you on the next one.